Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, September 10th, 2025. It's 1:32 p.m. Eastern Time. I'm starting the video. I'll do just a kind of a quick update. It's another go nowhere day in the market. Remember, we're kind of in a holding pattern. Big Fed meeting next week. Supposed to be or almost certainly will be the start of a new rate cutting cycle. Futures are still pricing in not a near certainty, but a very high probability of only a quarter point cut, despite the fact that we had a benign PPI report today. But that's how you read it. You can go to Google the term Fed Watch tool, you'll get this. And the way to interpret this is the next meeting next week, Wednesday at 2 p.m. They'll make the announcement. And the current target rate is 4.25 to 4.5. They don't; those are basis points. You put a little decimal there, and so you can see there that they're pricing in a 90% probability that the rate after that meeting will be 4 to 4.25%, the federal funds rate, with about a 10% chance of a 50 basis point cut. Yes, obviously that would be big news. Thing is, the Fed of in recent years really doesn't like to surprise the markets. They haven't done that in a long time. They tend to telegraph everything. So at most, you'll probably have them, give you the quarter point, and they could certainly, jawbone the market more dovishly. We'll see. We still have CPI tomorrow. PPI is the Fed's preferred inflation gauge, but again, we can see that the biggest component of the CPI is owner equivalent rent housing. Now, I don't know how to track that. There is no way to track it real time. Let me clarify. I do track Google Trends. I'm sorry, not Google Trends. I do watch that in various terms. But the Zillow and Redfin, the real estate market, we know has certainly turned. I watch the major markets, some regional markets, local, national. And now the thing is, owner equivalent rent is not the Zillow home price estimates. It's not. It's a kind of a convoluted mix there of what you could rent what people think they could rent their house out for. And so ultimately, but when house prices fall, rents will fall and all that. So again, we right now don't expect any big surprises anytime soon in inflation. But as I did show you, commodities have been ticking up. And we're going to talk a little bit about that, kind of what to expect going forward longer term. So there it is. That's what as of now. You can watch this yourself. See you into next week if that changes. QQQ, not much to update. I was going to jump over to Treasuries. I'll do that now. There were a few questions. Suspending is just that, not canceling, but suspending stops for the next couple days because we were in such close proximity. Remember, we closed a mere fraction, about 0.1% above that 580 level yesterday. Right now we are, let's do the measuring tool. You go like this, zoom in, grab 580 or close enough. Actually, the line should be a little higher there. That line needs to go up to 580. There, it's about 580 right there. And remember, closing, this is a 60-minute chart, so it doesn't, these candles, the end of day close, you have to look at the last candle of the day. So we've had a few intraday pierces. And right now, again, I'll grab as close as I can. There it is, 580.02. And we are still a whopping, as of right now, if I can get it, yep, there it is, 0.2% above that level. So if somebody asks, so are we, doing this or that? Are we still short? Remember, we don't trade each other's portfolio. It's not an investment club. You guys do you, I do me. I have a diversified portfolio. I have still a small starter position in QQQ. I cannot emphasize that enough. It is far from an all-in moment with Qs near, threatening to break out to new highs. But again, the technicals are the technicals. That's what's keeping us short. We had sell signals recently and objective short entry on that kickback there. That's where this trade was entered. And so as I addressed in that thing, as far as suspending stops, we're underwater by about 1%, but also we've already hit our first target for a gain of almost 3%. So it's profitable. It's a re-entry, whatever you want to call it. Everybody stops different. And then, as I mentioned in there yesterday, I kept talking about in the videos, I was thinking it was a 6 to 1 R, This was our original short entry right here. I'm going to grab that level with the crosshairs. And T5, which is just, again, almost certainly I'll be adding additional targets or extending this trade. That's an 8% drop from the initial entry point, giving the trade a phenomenal RR of 8 to 1 because that 580 stop was only a 1% stop loss. So by expanding, in my opinion, I'm taking virtually zero risk. You have a stock like Oracle up 30% today or whatever, but it's not moving the needle. I'm going to get to the market breadth right now. Really poor internals on QQQ. My point is, on a really, really strong day, one of those rare days, and you usually only see them when the VIX is elevated, 3% is considered a really big up day. So this thing could go up 3%. It's not obviously not doing it today. We're flat. And then it extends it from a 1 to a 4% stop loss, still giving you a 2 to 1 RR, which is still a favorable risk reward ratio. So that's my mindset, guys. Wait till the noise, wait till the CPI's out. And then based on the technicals, that's all we can go by. We can sit here all day long and talk fundamentals, and it's fun. It's fun to have that discussion, but at the end of the day, technicals are going to dictate a trade. And so what you had here is a breakdown and a back test right here of that most recent wedge. This was a divergent high here, negative divergence at that pop yesterday, or today. Actually, that was yesterday's close today. And so what we have now is just another wedge. Remember, we had a wedge here, divergent high. We had a sell signal, first sell signal there, went down, hit T1, or no, we already hit that level. I'm sorry, we re-entered, we waited to that entry point there. So this right here says on the 60-minute chart, we have a divergent high, and I just added today, as you can see, a secondary uptrend line. Has plenty of reactions, comes off the same recent lows there, catches 1, 2, 3, 4, 5, 6, 7 candles, and we just cracked that. But again, we're going to have a CPI tomorrow. We'll see what happens. And again, that's it. So I just wanted to say that, suspending stops, I'll do that from time to time. I'll do it during the earnings seasons. I'll do it around Fed meetings and announcements. Again, depending on where position is, you don't want to be way underwater and then start, pulling your stops. That's just sloppy money management. But I see virtually no risk to the upside right now, or minimal, I should say. Once again, based on how much QQQ is going to move. I'm going to get to Treasuries. I'm on QQQ. Let's just go there real quick, and I want to show you something about the market internals. So this is QQQ, the regular NASDAQ 100 tracking ETF. You basically, if you make an equal or marginal new high, as I told you, it would be still just these divergences are growing bigger and bigger and bigger. And that's usually what happens until ultimately they play out. Just like here, we had divergence. I talked about it every day. People get tired of hearing it. And then we had a new marginal pop, a pop that was expected and did fail, breakout that failed. And that was followed by one of the biggest drops in years. And it was pretty quick and swift on the way down. So again, the technical posture, we're in an uptrend. There's no mistaking that. Can't spin that any other way. But the technical posture remains the same. Big divergences building and just needing that catalyst. And as I've said, the big catalyst is going to be, I think, a break below T2. That 55.88-ish support level. Obviously, it's going to help to take out T1 since we've had several reactions recently. And then each one increases the odds to go to the next one. And then, as I said, if and when we get down to T5, you're going to have taken out T2, which will have, in my opinion, and again, it's based on analysis of multiple time frames on the indexes, SPY, QQQ, the big stocks, which I'll touch on real quickly. I'll touch on NVIDIA and Apple today at least. But I wanted to show you the disparity, if you will, between QQQ, the NASDAQ 100 ETF, and QQQE. That's what you're looking at. I just toggled over. Let me go back to the full screen there. And you can see QQQE peaked here back in July, end of July, and is going sideways. So again, it's not going down, but it's not going up. And now most of you aren't trading QQQE. You certainly can, but it's to me, it's an easy way to gauge the breadth and the internals of the market at any point in time, because it shows you again that concentrated lift that NVIDIA is going to get to. And I'm going to get to NVIDIA in a second. There's certainly, I want to give you an update there as well. All right, so that's that. And when we go back, I want to show you real quickly how I've shared this many times over the years. This is something I came up with well over a decade ago, years ago. A way to get real-time internals on any sector, any ETF, any index, just about. And again, using this charting platform, you might have another one that will let you do the same thing. So on the right of the screen here, if you'll note, I have all the components loaded, and I always have them, I typically have them sorted. I have multiple monitors, same watch list on, half dozen monitors. You're looking at just a small part of one, but sorted by market cap, because these are the guys that move the market. The rest of it, as I've said, you take the top 10 stocks, even the top 8, add them up, and they dictate where the market goes, not just the NASDAQ, also the S&P. Everything else just doesn't matter, especially, any one single stock. And again, Oracle's a great example of that today. It's not a small company. I think it's about a $700 billion company, if I'm not mistaken, somewhere in there, and close to it. And it's not even moving the needle on the NASDAQ today. What's moving the needle is NVIDIA right there. All right, so what I do is I click on this column, sort by percentage gainers, and you can see, so these are all the stocks green out of the 100 in the NASDAQ. That one's 0 flat, so I click on the last one positive. And then at the very bottom, you probably can't make it out in the video. I like the font small on the screen, pack in as much data as I can get. I can see it there. 29 out of 99 items in there, so virtual 100. So that tells you that over 2/3 of the stocks in the NASDAQ 100 are down. And again, that's also easily referenced, if you will. You can see the disparity when you go to QQQ being up slightly, up 0.13%, versus a whopping 1% down in QQQE. That's pretty notable, guys. It's just showing you again what's going on in the market. It's a circle jerk of AI. It's the big Microsoft, Alphabet, Meta, and the like, spending insane amounts of money on the AI race. It's just like the space race between Russia and the Soviet Union back in the 60s and 50s. This is the AI race between those big companies. Apple, obviously, it's been reflected in their stock price recently. They've been really behind the curve on it, and again, we'll get to that one second. But so the more they spend, the more they're buying NVIDIA's chips for the time being, still the dominant chip maker for AI chips. And again, that when that reverses, it's going to be one of the most powerful and profitable trades in many years. Just like it was on the way up, it'll be the reverse on the way down. And the thing about that too, just remember, I talk about it often, stocks tend to fall a lot faster than they rise. So, all right, so you can kind of, again, I showed you the how to gauge the breadth on the market. Again, nothing alarming, but it's not a one-day thing. It's a trend with QQQE kind of stalling out here. And when you look at the equal weighted, you can see it put in a big divergent high there. First divergent high since this one. Last one, we had that big drop into the April lows. And this one, we're just going sideways. And so whichever way we resolve here, upside break, I'll say it as I often do. I'll give you my opinion that upside break, just like I was saying back then, if and when the NASDAQ were to break out of the trading range it was in, it had a comparable sideways range, that it would have projected or forecast or predicted it would be a failed breakout due to the divergences, overbought conditions, and go down through into the bottom of the range. And then we covered all our, or at least I posted it, covering all shorts full long on April 7th at the bottom. So this one is going to be the same thing. We could break to the upside. There's no guarantees in this. It's just my analysis, my opinion. It will. What is fact is if it happens soon, as I'm drawing here with these arrows, this is not opinion. It's fact that any marginal new high soon will be a divergent high. Doesn't mean you must go down. Doesn't mean it must fail. Just means, in my opinion, the odds strongly favor that it will. Now, that's one scenario. The other scenario, break down below 96.52 in QQQE, then has to run, test the 200 days. And if and when it takes out the 200, especially the main indexes, as they always do, that is super duper bearish. So many for many, many years, especially in modern history. Computer programs or algorithmic trading programs, various trading programs, and humans alike are programmed to sell and get out of positions when the 200s are taken out and the key indexes, and you're in a bear trend when below. Short rallies back to them, as we did back at the time. And then once you're above them, no more shorting as stated back then at the time. When we had a re-short range, no more shorting above the 200. So now we're well above them. That was then, not shorting here. We had more recent sell signals there on the NASDAQ 100. All right, let's go to, let's stick with this, and then I'll get to treasuries, and then we'll probably wrap up. So what I wanted to show you is go back to my market cap, talk about NVIDIA. Okay, although I often cover NVIDIA in videos like this, the last chart I posted, meaning a screenshot, a static chart, was right here. All my charts are always time-stamped for kind of documentary purposes. You can see when, what time of day, what day it was, what time of the day. And that was it. We had put in a divergent high right after earnings, had a sell-off. And you can see, as always, arrow breaks to note where I expect a reaction. So I used to sit there and bother drawing out all the arrows. If there's a break, that's where you expect a reaction. And then once that level goes, it opens the door to the next leg down. So these are all your reaction points. If you're new to the site, this is how I draw my arrows. They're not projected in time. I did not expect, absolutely not, never do, when you see these kind of arrows or the up arrows, that's going to be a path it takes. On the contrary, that's why there's arrow breaks. That's where reactions, so it's something like this. Hit the first target, 165.44, bounce, have another leg down. Whether you hit it again or not, you may bounce. It's support. That's all I can guarantee you, or tell you, I'm sorry, is that support is support until unless broken. Once broken, it opens the door to the next leg down to the next target, 152.36, then 142.50-ish, which also comes in with the 200 days. That's an area where you probably have it, especially if you take out that second target there, an even bigger bounce, most likely. Again, depends at the time, how the charts in NVIDIA look, how the charts of the broad market look. But again, 165.44 was where I expected my first reaction. That was at the beginning of the month here. That was in. Today is a few days later, and what has happened? You hit it to the button. That would have given you as a an opportunity if you were short NVIDIA going out into earnings. Like I said, I'm watching and I don't have a position in NVIDIA right now, but it would have been a very objective level to cover short and or take a long. I know there's some of those that are bullish right now. I got one subscriber. He's buy every dip, buy every dip. Well, you don't. It's theoretical. Nobody does that because you don't have unlimited amount of money. It's just, I don't know. It's kind of a semi-useless statement. Buy every dip. But if you're going to buy dips, the dips I buy are dips to pullbacks to support. Again, you got to do everything. If you're just buying and selling in the dark, there's no strategy involved in that. What you want to do is buy pullbacks to support. So NVIDIA hit and bounced right off that first target there. We've had a bounce. I could probably put up some fibs, and we're probably within a normal retracement. I'll do that real quick in a second here. And now we need to reverse, which I expect because that was a pretty powerful divergent high. We broke the primary trend line here, back tested it, set up, made it ever so slightly marginal and still divergent high, and we've been moving lower since. So let me go to the 60-minute chart. You can see here's my lines on the 60. And let's, for kicks and giggles here, put up some Fibonacci retracement levels. Let's move that away. And we'll pick that, looks like the highest point right there, that post-earnings pop. And tells me we've retraced, we're sitting right on our hair above the 61.8 Fibonacci retracement there. So not a lot of resistance there. There's some minor resistance. Let me go back to my other board here. You can put a line right there. Yeah, I'll just say it right now. Based on the powerful sell signals that we just had, or the high probability sell signals, or there have been several of them. And I do see a reaction here, a couple reactions actually. Reactions there was resistance, then it was really good support, broken. We took it back a little. This was all kind of as the stock was wobbling around leading into earnings. So yes, this is an objective short entry with a stop somewhat below. Somewhat is going to be relative to your targets. Let's just talk in the video real quick because it is, in my opinion, well, not my opinion, I'm sorry, again, fact, the most important stock to the market, both mathematically, that is not a debatable fact at all. It's the highest weighted component by far of the NASDAQ 100 and even makes up almost close to about 8% of the S&P 500. Think about that. There's 500 companies in the S&P 500. So if you have the equal weighted S&P, and you know, any single company is going to make up what is that, 2%? Did I do that right? And you have yeah, roughly you have 8% weighting on NVIDIA, and I'm sorry, 0.2%. This is NVIDIA right now. This is the weekly chart. What I'd like to point out to you, and I've already have the last two charts I gave you were the daily I just gave you there. Let me pop up my weekly chart here real quick. Hold on. And this was the previous chart that I posted on NVIDIA. It was a weekly. I'm trying real hard to fit this into the little screenshot that I'm taking on the monitor. There we go. That chart is dated, as you can see here, June 25th. So again, it was only the last chart before that one I just gave you the daily on September 2nd. And so I highlighted this divergent high, and we had just broken this primary uptrend line right here and made a kickback rally. Sometimes they break down, never look back. And so these are the levels on my more powerful weekly chart right here, and where we're going longer term. So you know, like I said, we need to take out some of those nearby levels on the daily chart to make that happen, but it's still where I see things going. And that was, again, that was right here. We broke down, we back tested since. This is the same trend line, and we've been clearly moving lower. In fact, this is the first week we had 1, 2, 3, 4 solid weeks of selling, red candles, and this is just a snapback rally. Nothing goes down forever. I think you'll find, you look around, you're not going to find many other periods. There's 4 red candles. So that's it. So the stock was oversold, and not only that, they bought it exactly where I figured they'd buy it, right there at 165.44. I mean, there was an intraday breach, but we kissed that level and bounced. So that's all this is. And again, I'm spending a lot of time on the video. I know that because it is by far, again, I said, you know, not just the mathematical importance of the indexes, but the psychological importance. All things AI right there. This is the poster child. Nobody will argue otherwise. And so that's the psychological importance of this stock. When it goes down, it will take the market with it, just like it's taken the market up with it. All right, so that's it. And simple stuff. Like I said, we had some minor resistance. I just showed you on the 60. I'm going to put it right up here on my daily. And so the next time we revisit this, I'll mention that we did that. And if we pop it, you know, I'll tell you right now, I'm just going to extend these divergence lines. And, you know, again, I don't have a position to be short NVIDIA is just, it's redundant or overlap if you are short QQQ. So that's what I have right now. So NQ starter, still a starter position, NQ futures, which are going to go up and down with this one. But again, it's, you can see NVIDIA's up 4. Why isn't the stock market up much more than that? Why are the equal weighted flat and the regular NASDAQ 100 just barely positive? Again, because most other stocks are down today. That's the reason for that. And before we leave NVIDIA, as I've mentioned here, we've got a couple things going on the weekly chart. You have this PPO, as I've mentioned, these big green, what I call hills. You have red and green hills. These are your trend, the bigger trends in there. Again, when you're looking at the weekly chart. And as I often say, you do not have to be an expert market technician or chart reader to see which way this is going. And if you want to zoom in really close, and I encourage you to do the same. There was a period we were getting down, but not all the way there. We had another rally, and that also came after a 70% drop, coming off a big positive divergence, divergent low, all that good stuff. My second price target being hit, covered that. There, we shorted this. We shorted it here, I believe, on that trend line break. Might even no, we might have been short off that high because it was, I believe, a bearish engulfing. This is a weekly, but what I want to show you is that when you get those big green hills, you can do this yourself. These are big price or percentage changes, percentage drops. And it's easy to do. I'm not going to do it now. It's going to take a lot of time in the video for me to zero in, but I encourage you to do the same. Check, remember, every candle's a week here. So you're talking several weeks and almost always double-digit drops. At worst, when you get this one right here, for example, you had a drop and you absolutely, if you were bullish on NVIDIA and long, you made no money for almost a year, half a year right there. Those are weekly candles. And again, so there was a, strong uptrend. This is when the stock has its powerful uptrends during these green hills. And it's simply a momentum indicator. It's a PPO histogram. And you can see, so this is showing you the PPO is about to it's poised to make a bearish cross. Once in a blue moon, it'll hit that and you get a little whipsaw and a kiss and one more thrust up. But ultimately, again, after these big runs, once it's exhausted, you get the trend change. And again, in this one, it was a 69% drop. This one, we hit my first price target there. We're heading to T2. But again, for the reasons stated on April 7th, time to cover all shorts, go full long. So that was like I said, a truncated trade or an expected bounce on NVIDIA on the market at that point in time. And that's where we've carried. So I just wanted to reiterate that these weekly sell signals are intact. That'll be an additional sell signal or bearish technical event if and when we get that, or not if, but when we get that bearish PPO crossover on the weekly of NVIDIA. Okay, the other one we'll talk on real quickly is Apple. Another way to use the PPO, let me park the histogram. Apple histogram is clearly green right now, but Apple's been really lagging, as I mentioned, kind of behind in the AI arms race, if you will. Peaked back at the end of 2024 right there. That's the all-time high on Apple. It's not too far off, it's not a horrible looking chart. But another way to use the PPO on this weekly time frame, or just about any time frame, is whether you're trading above or below the zero line. That's the zero line right there. You can see these purple boxes. In using that, I always focus on the 9 EMA, which is your signal line, because that's the latitude across. By using that instead of the PPO line, you'll help filter out whipsaws. So basically, when you cross down below, it's bearish. I'm not going to, again, you can do this on your own chart, measure exactly how much, but all the big drops, and they're all marked here on here. I don't know if you can see them. That's 45%, 32, ultimately 34, 39, 35, 32. There's a 21, and so forth and so on. They were marked by the PPO signal line, crossing below that zero line and trading below it, okay? And so it's not an exact timing indicator. In almost all cases, we've been short before it crossed due to trendline breaks and things on the 60-minute charts and daily charts, and we've been long in covering our shorts before it flipped back. But it is kind of a bigger picture trend indicator. So not only that, not only are all of these healthy double-digit drops, where again, this stock got cut in a third, in many cases to as much in half, and even more if you go back farther in time. I do have them marked up. But without exception, that's bearish territory for Apple, or most stocks. Again, every stock I look at their own. And the thing about that zero line is it acts as support and resistance. In bull trends, you want to typically buy pullbacks to it. It keeps the bullish trend intact. But once you cross below, as you can see down here, I believe you can in the video, if you back test that line, there's times you get rejected and you keep the bearish trend going. And so that was over a year-long drop of about 32%. So Apple, you would have lost money consistently for a year and lost a third of her value had you not heeded that warning at the time. Again, there were many other reasons to get short back then. I'm sure if you go on the site, if we weren't short Apple, particularly we were short the market or both. Beautiful little bearish wedge breakdown back test. And what I wanted to highlight for you is right now we're back testing. So Apple broke down here shortly after it peaked. That was a divergent high. That has the potential to be a major top. Again, it's not as if it wasn't. It already had the biggest drop in years. It dropped 35%. The million-dollar question Will Apple power up through here, power on to new highs? Quite possibly. I don't know. I just wanted to point out that that's at level. And there's a potential uptrend line. I'm not super crazy about it, but just want to point that out. If Apple does happen to make a new high on this weekly, it will still be a divergent high, and it's just a matter of they can extend the stock market rally by another few months before these divergences grow even larger and then ultimately play out. Okay, and what I wanted to get to are Treasury bonds with the Fed coming up. Just a quick overview there. If you are new to investing or trading financial markets, know this, that the bond market is super important. It's larger than the stock market. There's more money in the bond market than the total stock market. And interest rates ultimately dictate where the stock market goes. Again, this is not an opinion or debatable fact. We were coming off one of them, and we're still in one of the largest secular bull markets in history, and that is no mere coincidence. We're just completed. In 2020, we completed by every metric the biggest secular bear market in interest rates, falling rates, and that was fuel for the economic growth, the stock market, easy money, and everything we've had. Now, as I've covered many times, by every metric, by the primary downtrend line being taken out, by higher highs, higher lows, this so far is pointing to the fact that secular bear market and rates has ended, and we're in the very infancy of a new secular bull market in rates. How that plays out, I'll do my best to help navigate it. We could certainly backtest the trend line. That would be one hell of a drop in rates in the 30-year bond, which we're looking at here, the yield of the 30-year, and do that, and it still very, very much would keep this new uptrend intact. Or the market, as they often do, and this, I know what the Fed did, the central banks, and then, of course, the federal government when COVID hit, but even going back to the Great Recession, 2008, 2007 to 09 bear market, the excessive and unprecedented amount of fiscal and monetary stimulus has been injected in the market. Artificially low rates for way too long. Fed kept the pedal on the metal when they didn't need to. That's what shot the market up to where it's at. And so, somewhere deep in my core, it's just a belief that there's going to be a pretty ugly price to pay for, again, keeping rates artificially low, too low for too long. And we're seeing it now. We've seen that already. You read about it. There's the biggest disparity in the wealth gap ever in history. The haves are getting they have a lot more now. The wealthy, 5 cars, 3 vacation homes, huge 401ks, savings, and the have-nots can't even afford a house, and and rates could come down quite a bit. Home prices are still way out of range, both prices and interest rates now. And again, so quirky things are going on with the economy. And again, this is in the early stages of, these are everything backfiring. Keep rates too low too long. You created a bubble in house prices and equity prices. And now you've trapped out a whole generation of home buyers. And again, so speaking to you, Federal Reserve. So now, by this chart, this is the monthly chart of TYX. As I pointed out back here, this was the most extreme overbought reading since 1980. So bonds, interest rates have been consolidating. Now, I can make a case, and it may be what plays out when I step down to the weekly chart here. This is that period of consolidation. We had negative divergence. You can see my divergence line started right here. Started building right here. This is the RSI on the weekly chart. Here's the PPO. And that's roughly equal highs. As I've mentioned, any new breakout above this level is going to take the 30-year long bond back to levels potentially not seen since the late 90s, at least the early aughts right there. Okay, that's going to be a massive psychological blow to the market. I can all but guarantee you that. Now, that may not happen. If I look at this and I want to try to be objective, We say, well, negative divergence. Yeah, like I say, breakouts that occur with negative divergence and overbought conditions have a much higher fail rate and often fail. So that case can be made technically. However, again, I think this is caught and just due to all these extreme, this is all the manipulation started. That's the financial crisis, all these crazy bouts of quantitative easing, followed by when the Fed and all central banks and federal governments around the world just went crazy with stimulus and artificially low rates. And so this is, I think, where it's going to really mess things up for a lot of us going forward. And we'll see. Now, so where am I going with that? So yeah, we'll watch Treasury bonds. They haven't broken out yet. If they do, be very careful. And yeah, this looks like based on the divergence, we could get that scenario where rates pull back in, and it would most likely also align with a bear market in equities. Typically, long-term rates will fall almost always during a bear market, meaning bond prices go up. For both a flight to safety bid with institutions moving money out of stocks into treasury bonds that causes their prices to go up, their yields to fall, and you also have a forecasted lower economic growth, which means lower inflation. That's the other reason rates fall. However, again, and I'm just covering the scenarios here, guys, and let's watch it and let the charts be our guide. I can easily see the possibility with all these shenanigans that have happened in recent years. That we break out and just keep running there. I'm going to give you an example right here, a real-time example. Everyone's watching. This is gold. Gold had almost the same thing. Gold, this was the last bull market in gold, ended in a blow-off top. Back here, this was my uber bullish number when 130 got taken out. Predicted we'd start a new bull market in gold, and we did. But then gold had this period here where it went just like treasuries. I'm just showing you I just showed you a multi-year consolidation in treasuries in the same range. And the yields, the yields. Equal highs, right? Just exactly like the 30-year right now has, TYX we just looked at. Clear negative divergence. And so you guys hear me say this all the time. Divergence, A, is not a sell signal. And even though I say more often than not, breakouts that occur with negative divergence and overbought conditions fail, that hasn't been the case in gold. You can see we broke out of this trading range. And as I often refer to these things, when you have these very well-defined sideways trading ranges, it's powerful. And so I'm going to just leave it there. Respect what happens. I will try my best in real time. If treasuries do break to the upside or break to the downside, I'll continue. And you know me, I'm always covering treasuries in these updates. But I just wanted to lay out this scenario, and that's the same thing. We had these equal highs, 1, 2, 3, 4, negative divergence all the way up to the end there, actually right there. And then what happened? The divergence got burned through, took it out, and had that big rally. Now we do have divergence forming again. As I mentioned this, as I've told you, we had a more recent breakout in gold. In this one, I'll put good odds it's most likely going to fail. This is a daily chart. There's a divergent high. We had one right there. We had a multi-month correction in gold. And so, but we just don't have any sell signals. We did put a bearish engulfing yesterday. Look at that. Maybe we'll see. Okay, so that's that. And then finally, since we were on treasuries, let's go back there and I will wrap this up. I've talked about this. This was the last Fed rate cutting campaign. We're about to embark most likely on the next one. We know we're at least, it's almost a near certainty we're going to get at least a 25 basis point cut. Fed started with a bang that time around, 50 basis points. So what happened? It was telegraphed. Again, the Fed telegraphs the hell out of everything. You're going to let it be known when they're going to cut, not cut. They do not surprise the market. And the market, just like now, knew it was coming, and the 30-year yield fell. But what happened the day they cut, and they cut 50 basis points, the bond vigilantes came. And this is where the Fed lost control of the bond market. And I've covered this many times, including back at the time. And the technicals said that would happen, right? You had a big divergent low. Long-term yields went up. I can't tell you if it's the first time in history, but it is possibly the first time and probably the most pronounced where instead of rates doing this like that usually does when they cut, especially a cycle starting with a 50 base point cut, but the other way. So just want to point that out. Yeah, rates have been falling. Everyone hurrah the PPI numbers today and all that, and the bond market certainly did. It's at support now, but just note that don't read too much into this, and don't read too much into what the bobbleheads on TV are talking about. That, oh yeah, we're going to maybe even get a 50 base point that's going to bring rates down. Let's see what happens next week. And all I can tell you, the market's probably going to grind around between now and then. I am very eager to see. We'll see what the technicals say. Right now, I can't make a case yet to short treasuries, which is to go long yields. There is some support right here, but there's also support below. I can see a couple reactions here. Believe me, I look at the 60-minute charts. I don't have a position, as I've told you for a while now, in treasuries. I'm watching this to see what happens, because if this happens, that is going to be no bueno for the stock market and the economy. So let's just wait and see. Right now, we get closer to the meeting. That's where you saw this big drop down, just like here, because the meeting's coming up next week. And maybe that will continue. I don't know. We'll try to next week, or we'll take a look at the charts and see if they're setting up to make a trade in either direction on treasuries, and then what it might mean to the stock market. I'm going to end the video here, kind of looping back to where I began. I gave you recently a new trade on SMCI, and that's still an active trade with a stop on a daily close above 49. I wanted to point out, because I started in the video pointing out that NVIDIA was an objective re-entry after that bounce off that first expected support level / price target. SMCI is also, I haven't touched this chart. You have this, you can click below this post, click on SMCI. It'll bring you to the previous coverage, including the trade. That 44.53 is really nice support. I see a reaction high there. It was resistance here. We broke out, ran away to new, not all-time highs, but new 52-week high, maybe, or close to it. Then it was support, resistance once broken, and we're back there again. We're also back to the down. We're at the apex of the triangle. That's resistance. And you see what happened recently. I talk about these 200s all the time. Look at, you tell me that the computers and or man and machine are not trading SMCI on the 200s. 1, 2, this is the 200 simple, by the way, this blue line. 3, 4, 5, and a reversal. I also talked about this being a sister trade to NVIDIA. NVIDIA bounced. Where did NVIDIA bounce? Exactly where I figured it would bounce based on that last chart. So this is the expected bounce, right back into resistance, like I just showed you on NVIDIA, and therefore an objective short entry. Now, my first target zone was a little below that. For all intents and purposes, I was effectively hit. You can see at the low there, you came within 1%, less 1.5%, less than 1.5%. However, this is a long-term trade, and I still maintain these targets. So all I can tell you, again, just like NVIDIA, it's an objective short here. You might want to keep that stop there a little bit above that $49 level. It's up to you if you want to suspend stops or hold off. Bottom line is, I'd keep things light until the Fed's out of the way. Who knows? If they do 50 basis points, this market could go crazy on the upside. But guys, I've traded long enough, and I can cite examples of when they cut 50 when it was unexpected, and the market absolutely freaked out on it. So again, it's about the market's reaction, not what you think might happen or what Kramer or anybody says may be bullish or bearish. So that's it. So you get a couple trade updates. You might have heard the little bells go off. I just had a price alert. I'm going to check it now since I'm doing the video on open. Open. I'm on a daily chart. Where did I have it? I must have had it on I probably had on the 60-minute chart. Let me see, where was that? Oh yeah, here it is. This is my 60-minute chart. Needs a little more work. Take out that uptrend line there and go back to the daily. You can see I have a little minor trend line, and oh yeah, big. I like this one, guys. Open looks really nice, right for a short trade. Once it takes out 487, it's probably going to continue to fall. I think this one's going to come all the way back in here to at least. I'm going to give you a target zone. Just eyeballing the chart right now. I may sharpen my pencil on this one. I'm going to say right here, minimum target $3. That's going to give you, if you took it here, about a 46% drop. So I'll revisit this one later and mark up those targets for you, potentially more. The other one I had an alert on earlier today was ADP. Again, I've been saying this, and I think if you read a lot, listen to the right people, you hear what they're probably saying, what I'm saying. The stock market needs to be careful what it wishes for. It wishes for weak weak jobs data, so the Fed will cut. It wants its juice. It's a heroin addict, and it wants that heroin so bad. That heroin is low rates. But again, be careful what you wish for, because that will be the death blow to the stock market when employment finally turns. And you can watch stocks like ADP, and ADP right now is testing that major trend line. I had a price alert on it today. This stock has a lot of downside potential. Here's the weekly chart. So it's pretty much on that. Let me tighten that up for you. And again, just one to watch. You can take it as a short if you want. If it breaks, it needs a little more work, a little more downside to take out that trend line, as I just showed you on the daily, even though I had an alert fire off. My alerts will happen just if they touch the trend line, that's all. Or actually, it took it out. Oh yeah, we're a little below it now. Oh, and we're also, by the way, we just lost the 200s. So, not unusual to see brief spikes below. But when you're below the 200s, watch out, because that's usually where bear trends begin, once the 200s are taken out. And again, this is in my things to watch list. This is a tell on the jobs market. And again, if you're new to this, there's not a single thing more important to the U.S. stock market and the U.S. economy than jobs. Because consumer spending is 2/3 of GDP, and it doesn't take someone with a PhD in economics to know that when people lose their jobs, they tighten the belt. All right, on spending. And so there it is. Paychecks has long since peaked after that divergent high, has also taken out its 200-day moving averages, clearly below them. This is the other big one, and also just took out my 135 target. I would have given you these before. So I believe here on that wedge break, short entry there, and this stock has already hit that 135 target for about a 14% drop. And when I look at the weekly chart, you see my line where I think it's going. Minimum right here, 105.38, and it's not going to go straight there. You've got support here. You're going to have some stops along the way. You just are starting to crack this level here. But again, I'm going to turn off all my lines. And let me just show you. If that 105, and that's again my minimum preferred long-term target, that's a 33% drop. I don't think you're ever going to see that outside of recession. And you're also now, like I said, paychecks. Took out the 200s, took them out right here, had a little punch back, but lost them again. And either way, the stock fell for about a year, over a year, about a 17% drop. Here's a very key long-term trend line here, the 200-week EMA. But there's where it took out the 200s right there. COVID took it out there, just took out the 200s. And you go back to the last real bear market, 2007, that's where you took out the 200s. Then you took out that 200-week EMA, and there came the bear market. So, all right, let me wrap it up here. Long video. Let me get it out to you guys. We'll pick it up tomorrow after the CPI. This has been Randy Finney with Right Side of the Chart.